Hello, this is Jordan, and this video is being recorded on Wednesday, September 22nd, 2021. Thank you so much for joining me today. Please like, comment, and subscribe if you're watching this on YouTube. And in this video update, I am going to discuss, or at least answer, the concern that precious metals are about to repeat what happened in the 2013 to 2015 period. Now, starting off, this is probably my favorite big picture chart because we're essentially looking at the gold stocks against the S&P 500 as well as the CAPE ratio at the bottom. At the top, that's just a nominal look at the gold stocks. And you can also use gold against the S&P 500, but as we know, gold was fixed until 1971, so gold stocks give a better representation up to that point. And so if you're not familiar, the CAPE ratio at the bottom, that's a 10-year PE ratio. It's a very long-term indicator for the stock market. And so when the CAPE gets very high, that is a signal that forward returns from stocks over the next decade, are likely to be historically low, and vice versa. When the CAPE ratio is low, the expectations for stocks as far as forward return over the following decade are very positive. Now, I've mentioned this in past videos, but it's important to mention again. If we look at what happened in 2011 and the years before, if you look at 2009, March 2009, that significant bottom in the stock market, the CAPE ratio hit a low of 13 then. And then around the 2011 peak in gold, which coincided with the stock market had a 20% correction into that peak for gold. The CAPE ratio was 19. And as you can see, up to that point, precious metals had been outperforming the stock market and really everything for 11 years. And so the valuation, the CAPE ratio being at 19, if you look just the past 20 years from, let's say, the early 90s to 2011, the CAPE ratio in that short span of history was actually relatively valued on the low end, just as far as that past 20 years. And even if we're looking historically, a CAPE ratio of 19, not that extreme. So somewhat reasonable. So it's much different today, obviously. The CAPE ratio is at 38. And so the CAPE ratio is at a point where it's higher than at every other period except for 1999 to 2001, when the tech bubble was nearing its peak and at the beginning of the end of that tech bubble. So the situation today is much, much different. Essentially, the stock market it's nearing the end of its secular bull, and gold is, gold stocks and gold, they're still historically very, very cheap. It's completely different from 2011, 2012, 2013. Much, much different. And just to go more in depth on that, in this chart we have gold at the top, we have the CAPE ratio in the middle, and we have the S&P 500 at the bottom. And so, again, in 2011 when gold peaked, the CAPE ratio was only 19. Again, it was relatively low compared to the past few decades. And around that point, the S&P 500 corrected 20%. And so that low in 2011, the S&P held its 40-month moving average. These are weekly charts. I'm using the weekly equivalent, which is about a 165-week moving average. And so at that point in 2011, when the S&P bottomed, it was trading at the same level as 14 years prior. So no performance, essentially no change over the last 14 years. And I believe that was, again, 2011. But eventually, in less than 2 years, the stock market had that huge historical breakouts. This is 2013, right when gold had its major breakdown. I think gold broke down first, stock market later that year had a huge breakout. So the S&P, it broke out from 13-year resistance. So that's a very significant breakout. Very significant. And, since then, obviously, the stock market has been the place to be. And, I always talk about this, that until gold is going to consistently outperform the stock market, you're not going to see a real sustained bull market in gold. But nevertheless, even with that being said, gold was able to rally 2016, and then from 2018 to 2020, it had a really nice move. So in nominal terms, gold has performed okay. But again, we're at a completely different situation now, where the CAPE ratio is twice as high. If we look at the stock market, I mean, all the valuations are, all these valuation forward return indicators, I mean, they're all at absolute extremes. They're very close to absolute extremes. So it's a much different situation. And, what we can see is that, gold is building the handle on this cup and handle pattern. I mean, it's a 10-year or 9-year long cup pattern. I mean, that can take 2 years, 3 years to play out. I mean, that would not be unreasonable. And so we can see here that eventually, when the stock market runs into problems, that is going to be around the time when gold is really going to get going and eventually have, a massive breakout through 2000 again and trade much, much higher over the coming years. And, interestingly, I want to point out, I talk about gold in the 40-month moving average. I mentioned the S&P in 2011 there. When it corrected, when gold peaked, it held the 40-month moving average. So the equivalent, the weekly equivalent of the 40-month moving average, I have it up there, and you can see the arrows, how it's been a very important level over the last 30 years. So over the months ahead, that is a potential downside target for gold. And, what if gold holds that? It could be very similar to what the S&P 500 did in 2011. It holds that, and then eventually, within the next, year and a half or whatever, gold could have a massive breakout. I mean, it would be, I mean, if it happened in let's say it happened in 2023, that would be a 13-year breakout for gold. So there's a lot of similarities, but the main issue here is this is not 2013 again for gold. With the macro, just the macro market situation is completely different. And it's important to keep that in mind. And, it's also important, which I talk about in other videos, to key on the fundamentals. If there's no stock market correction, gold is going to struggle in the meantime. And we're seeing that in the charts, in the technicals. And if that doesn't happen, the next case is a Fed rate hike would be the catalyst where gold really starts to get moving again and begins its next leg higher. And, today I just noticed there's there's a rate hike basically priced in by the end of next year. So 12 months from now, there's a 40% chance of a rate hike. So if the stock market doesn't correct and it resumes its uptrend, makes higher highs, the odds of a rate hike are going to move higher and higher. And the odds of it being sooner rather than later are going to increase. So we also have to keep that in mind. So I hope you enjoyed this video. Follow all my work at TheDailyGold.com. There's a lot of free stuff there. Consider my premium service. Thank you so much for listening to this video. Let me know what you think, and I hope to do another one in the days and weeks ahead.